Hi, I'm Kathryn Wilkens. In this short explainer video ahead of next week's guest episode, we'll look at different ways to measure investment risk. Our guest, Adam Link, goes beyond standard deviation. This video will help set up that conversation.
Welcome to Expanding Frontiers from Pearl Quest. I'm Kathryn Wilkens. Here, we explore the evolving edge of investing, data, and the frameworks that help us make sense of it.
All right, let's get right into it. Welcome to this explainer where we are diving into a really fascinating disconnect. We're going to look at why the complex mathematical models that essentially rule Wall Street are completely disconnected from how the world's absolute best investors actually measure risk. If you've ever stared at your portfolio and thought, are these risk metrics actually telling me the whole story? Well, you are in exactly the right place. We're going to unpack some incredible research today that basically pits academic finance right up against the real-world strategies of billionaire investors.
To really wrap our heads around this disconnect, we have to start by looking at how legendary investors actually define risk in the first place. Listen to this quote from Warren Buffett. He defines risk very simply as the likelihood of a permanent loss of investment capital due to deterioration in the underlying performance of the business. That's it. For the most successful investors out there, risk literally just means losing your money because the actual company failed. It has absolutely nothing to do with whether the stock price went up and down a bit last Tuesday.
But then, look at the stark contrast academic finance creates here. Mathematical finance totally ignores the underlying business. It's wild, right? Instead, they define risk purely through standard deviation, which is just a measure of historical price volatility. It is literally just capturing the extent to which an asset's price moves around. Warren Buffett hilariously refers to this as jiggliness. The academics are out there treating complex living businesses like bouncing balls.
So, here is our roadmap for the explainer today. 1. The definition disconnect. 2. Why volatility fails. 3. Backward-looking alternative measures. 4. Forward-looking risk solutions. And finally, 5. The future of risk.
Section 1. The definition disconnect. Math versus reality.
We are dealing with two totally different universes here. On one side, you have the academics and global regulators, like the Basel III framework for banks, and they are treating risk like it's a physics problem. For them, risk equals historical, backward-looking variance, period. But then, on the other side, you have value investing legends, think Charlie Munger or Peter Lynch. They treat risk as a dynamic, forward-looking business problem. And our source material points out something absolutely profound. There isn't a single, notable, highly successful investor who publicly champions the volatility theory of risk. Not one.
Let's move to Section 2, why volatility fails, and the major flaws in the math.
Okay, so standard deviation actually fails on multiple fronts. First off, it penalizes a stock for going up too fast. Since it doesn't care about direction, a massive sudden gain gets mathematically calculated as highly risky. It also completely ignores whether an asset is cheap or expensive right now, which, let's be honest, is kind of the most basic rule of investing, right? Plus, it assumes market crashes follow these neat, predictable bell curves, totally ignoring fat tails. Those extreme, completely unpredictable market events. And incredibly, the supposed safety net of diversification? It completely fails when you need it most. During a major crash, everything drops at once.
This quote from Niels Bohr really hits the nail on the head regarding the whole rearview mirror problem plaguing mathematical finance. Trying to predict your future risk solely by looking at past price changes? It's exactly like trying to drive your car forward on the highway while staring exclusively into your rearview mirror. Think about it. Risk is always about the future, but standard deviation only knows what happened yesterday. If you want to see the devastating real-world consequences of this kind of academic blindness, we just have to look at long-term capital management, or LTCM. This was a massive firm run by the literal Nobel Prize-winning economists who practically invented these modern risk models. They made money for a few years, but then in 1998, they completely blew up. Why? Because the Asian and Russian financial crisis introduced a level of volatility that had never been seen before. Their standard deviation models failed to predict that risk could suddenly become infinite, and the entire firm had to be liquidated.
Which brings us to Section 3, backward-looking alternative measures, which we might just call flawed alternatives.
So academics realized the problem, and cooked up this whole alphabet soup of alternative metrics to try and fix it. You've got value at risk, expected shortfall, mean absolute deviation, the list goes on. But here's the catch. They all ultimately fail for the exact same reason. They mechanically rely on historical data. No matter how fancy you make the math, yesterday's price movement simply cannot reliably tell you if a business is going bankrupt tomorrow.
Let's dive into Section 4, Forward-Looking Risk Solutions, focusing on the subjective approach. This is where we get into how you should actually be thinking about risk. Researchers Mauboussin and Callahan developed this really systematic framework based on evaluating a company's moat, its sustainable competitive advantage. You analyze the industry to find barriers to entry, you assess the returns the company can realistically generate, and then you determine the fade rate, basically asking how long is this advantage actually going to last. By doing this, we completely shift away from calculating historical price jigs and we start systematically estimating future business durability. If a company has a deep, wide moat, the actual risk is low, regardless of what the stock price is doing today.
Even something as old school as corporate bond ratings offers a much more holistic view of risk than standard deviation does. Look at what credit agencies actually consider. They're doing management interviews, checking sector strengths, looking at cash flow and debt levels. They're incorporating a huge array of dynamic real-world business factors. Now, to be fair, they aren't perfect. We absolutely have to remember that they famously failed to predict the risks of mortgage-backed securities right before the 2008 crash. But fundamentally, their methodology is at least attempting to look at the whole, living business, rather than just staring at a single mathematical variance line.
Finally, Section 5, The Future of Risk, Beyond the Math.
So what's the biggest takeaway from all this source material? It's really this. Risk is like beauty. It is entirely in the eye of the beholder. A lot of the so-called progress made in mathematical finance is honestly a bit of an illusion. A true, holistic approach to investment risk demands a forward-looking, highly subjective approach. It's multifaceted. You simply cannot condense the messy, dynamic reality of human behavior, shifting regulations, and cutthroat market competition into one neat little equation. It just doesn't work that way.
I want to leave you with this final thought to chew on for your own investments and your own portfolios. Think about everything we covered today. The spectacular failure of LTCM, the simple wisdom of Warren Buffett, and that dangerous trap of driving while staring in the rearview mirror. If the past truly cannot predict the future, how are you going to measure your next big risk? Are you going to trust the math, or are you going to look at the business?
This has been Expanding Frontiers, a Pearl Quest podcast. Stay open to what reveals itself. Until next time.